So, can you make a mint on gold? Well, I'm certainly not the person to ask about that, but we have the right person here to start our thinking. She's a CEO and a fund manager who's previously turned around a smaller gold asset company. She was once, I'm told, a gemologist as well, and she's led an impressive global search to get more women in the mining industry. But she's here now in her capacity as Chief Executive and Gold Fund Manager at South River Asset Management. So firstly, let us welcome Amanda van Dyke.
Hello everyone, and thank you very much for having me. I'm going to try to go through this relatively quickly and then let you ask questions, because I think that's mostly what people want to do. I'm going to start with gold, and I need to, as an asset class in and of itself, and what drives the performance of the metal. The performance of the stocks is a completely different matter and is related to the performance of the metal itself. But nonetheless, you need to start with the metal before you can get to the stocks. So JP Morgan, a long time ago, said that money is gold and everything else is credit. That's been true for about 5,000 years. The reason for that is because paper currencies, or any currency that can be printed, whether you're printing general coins that aren't gold, can be produced in whatever quantity as is needed. During the recent financial crisis, we printed an unprecedented amount of money, most of it electronic. I read an interesting statistic recently. There's about $60 trillion equivalent dollars in global currencies circling around the world. Only 5 trillion of that is actually in paper form. The rest of it's electronic. And the majority of the quantitative easing money in the world has not been printed in paper currency, it's been painted in electronic currency. But that electronic currency has the exact same effect on global markets as the paper stuff does, frankly. And it's increased about threefold since the last financial crisis. So gold versus other commodities. All commodities in the world are demand and supply. How much you can get of it versus how much is wanted of it. The demand for gold goes up when people are worried about the value of their other assets. And there's lots of different asset classes in the world. The most common asset class most of us have is our bank balance, which is cash or electronic money in our bank. Then there's, the value of our stocks and shares, the value of our house, and then all the other stuff. But when you worry about the value of your stocks and shares and the value of your money because of inflation, or the value of your house for various reasons, that's when people tend to turn to gold. When inflation is devaluing all your other assets, that's when you run to gold. It is important to note with money and currency are different things. So money has two functions in the world. One function is a store of wealth, of value, and one function is as a transaction, is something you use for trading and transactions. Gold is a reserve currency, which means it's a store of wealth, and it's used as a currency of last resort for countries, for banks, and that sort of thing. But it's very rarely used as an actual currency for trading goods, and hasn't been used in a couple thousand years for that purpose. So that's one of the many reasons why gold is a slightly different currency than others. So as we said, the currency you can't print. That is all the gold that is in the world. The amount of gold that is in the world goes up by about 3,000 tons every year. There's about 166,000 tons in the world, and that's as much as we can get out of the ground. It's getting harder and harder to find more gold in the world because it's becoming lower grade and deeper and harder to find, generally speaking. So the amount of gold in the world is not likely to go up by more than 3,000 tons a year. And for the first time in history, gold is also being consumed. So gold is being destroyed, basically, the way we consume other commodities like copper and things we don't recycle. Every smartphone on everybody in this room, and probably all the tablets that you're watching this on, has a small amount of gold in it, and that gold is very, very small. It's a couple grams, but that gold is not being recycled for the first time in history. And so the 3,000 tons that is produced, about 5% of that is being consumed and not put back in for the first time in history. And it is actually expected that as the use of electronics goes up, we are probably going to consume more and more gold and not have it be put into the general world store of gold. Now, there are three things that significantly control gold prices in the world: in the long term, the medium term, and the short term. We're going to start with the long term. The long term strongest correlation to the gold price is real rates of return. So real rates of return are, you can put your money in the bank and get usually the base rate as a return on your money. So I think in the UK that's about 0.5% right now. And then you can also, and then inflation is going up at about, I think the UK is 2.2% right now. Somebody might correct me on that. But that means that with 0.5% return, you're losing 1.7% every year. You keep your money in the bank versus spending it or investing it in something else that makes you more of a return. So when you've got negative real yields on cash versus inflation, gold goes up, always. Now, inflation was flat as a pancake during the financial crisis. Some people thought it was actually negative, but governments didn't admit to that. And then it started to rise recently, but rates have also started to rise. So real yields are inflation minus the rate of return you would get on an average bank balance. That's changing all over the world. Inflation rates are different, rates of return are different. But generally speaking, rates of return are negative right now because we've printed lots and lots of money, and the only way we can get that money back is, or governments can sort of make that money back, is by inflating it away. So generally speaking, there's a belief in the world that while we are raising interest rates, gold has continued to rise even slightly because inflation rates are going up at the same time. And in the long run, there is a very close correlation or negative correlation to negative rates of return and base rates. The second thing is the other asset class, the other store of wealth in the world. And this is actually negative for gold right now. Stock markets, investments in the world, they've all been going nuts. They've been having a great, great run. As anyone who has a FTSE 100 tracker fund will tell you, or an S&P 100, it's having a great time. When stock markets are doing well, gold is usually doing less well. So on one hand, there are negative real rates of return. And on the other hand, we have an incredibly rising stock market. And that has served as a damper on the gold price for the last 7 years, frankly. It's been rising steadily. Now, 90% of asset managers like myself who invest in general equities are petrified. We all think that the valuations in the stock market are at historical, unprecedented highs. And they are going to probably, cyclically speaking, they will correct. And when they correct, gold will do extremely well, like it did last time gold prices, the markets corrected. That being said, the last run of a bull market in equities is the most exponential and extreme run in equities. So reasonably speaking, gold is pretty flat. It's range bound between 1,300 and 1,350 US right now. And while general equities are doing well and having their last hurrah of this bull market run in general equities, the reality is that's a bit of a lid and a damper on the gold price, and will continue to be until those prices correct. Now, when people think that'll correct, some people think it'll happen in 6 months. Some billionaire in Egypt just put $5 billion in gold because he's petrified of markets correcting. And slowly, asset managers are putting bits and bits more money because they're scared of that happening. But the estimates globally are between 6 months and 2 years for when that general equity market correction is going to happen. And the truth is that until that correction happens, that cyclical correction happens, the gold price isn't probably, I don't think it'll go much lower because negative real rates of return are still in effect, but it's probably not going to do exceptionally well either. That is going to be the catalyst for the next serious run in gold. Gold is literally getting more rare and more expensive, and while quantity easing has come to an end, nobody knows how quantitative tightening is going to work. Some people think quantitative tightening is going to be what makes the markets correct. I'm not sure. But the nice thing about gold is that you can't print it. And it is getting harder to find. So there isn't any brand new technology like fracking that's going to get more gold out of the ground. There's a set amount on the planet. The easy pickings have been had. And the likelihood is that the steady amount of gold going into the market will decrease rather than increase. So we discussed gold as a store of wealth earlier. The store of wealth is generally as a reserve currency. So when countries want to prove that they are actually strong, they keep gold. They keep gold in their central bank, and it backs up the value of their actual currency. And the other thing that I hear a lot of the time is like, well, gold's an old-fashioned currency. Nobody cares about gold anymore. The reality is gold demand's gone up significantly over the last few years, and the reason for that is because the people that believe in gold are the people in Asia, and they buy more of it every day. So while more and more Western world people are buying less gold, more and more Asian people are buying more gold, because they are petrified about the value of currencies. And gold has been a currency for them, has been a store of wealth and a method of savings for them, and they don't have a benefit system that's going to protect them in the long term. So they always keep, so every year they would put 5 to 10% of their savings into gold. It's always happened, and it's continued to happen despite the growth in Asia, despite the growth in China. And China has become Shanghai has become the largest global market from gold, replacing COMEX, which used to be the major trading center for gold in the world. As we were saying earlier, China has recently announced some of their gold, 1/3 of the amount of gold they have in their reserves, and they've also denominated a RMB gold option for the first time in history. And I believe we're going to discuss this a little bit later. But as I said earlier, gold is a reserve currency largely. It is not a currency for transactions. It's very hard to go out and buy anything in gold. It's a bank currency. It's a currency that serves like collateral for all your loans and that sort of thing. That is slightly changing recently. It started trading very recently, and it's not trading a lot. But in order to diversify away from what's called the petrodollar, the fact that all international oil contracts are denominated in US dollars, they have denominated an RMB gold contract, but the RMB isn't traded outside of China. So they said you can pay us in RMB, which nobody has, or you can pay us in gold. So there's a lot of people that are using gold for that purpose. So the question is, why would you own gold stocks and not gold itself? Gold will likely do a lot better as soon as the stock market's correct. It's probably range bound, as I said before, for the next little while. But the reason you want to be in gold itself, or in gold stocks rather than gold, is because on the whole, historically, gold stocks outperform gold 3-to-1. And the reason for that's reasonably simple. So let's say I'm your average gold miner, and gold is $1,300, and I produce gold at $1,000 an ounce. If gold goes up less than 10% to $1,400, I'm now making 25% more money. So the gold price has gone up 8%, but I'm making 25% more money. That's why gold companies do better when the gold price goes up than gold itself. So the question is, where is gold in this bull market cycle? Bull markets in gold, which this one started in January 2016, It's gone through a bit of a lull because the US dollar has done extremely well and the stock markets had a renewed surge. Is about halfway through, less than halfway through. Gold bull markets tend to last anywhere between 3 and 10 years. And these are gold bull markets in the past. We're about halfway through those graphs. And the idea is that in the next year or two, when stock markets correct, gold will probably take off, and it'll probably do extremely well.
We can move to the questions. We haven't
Sorry.
too much longer, sorry.
So that's about where we are in this market. And just so it makes, in case it makes any difference to you, I run a gold fund and spend all of my time buying gold shares and watching the gold price, so that's where I come from. Does anybody have any questions?
Well, we've got companies represented here we're going to be hearing from. You talked about why invest in a company rather than the physical product. In the end, though, you're just backing the management and the effectiveness of the company. It's difficult for people to get their head around why it matters they're producing gold rather than anything else. So can you just explain quickly, I mean, the kind of stocks you might have added, for example, to your own portfolio? What do you look for in a company?
Get a bit more level on his one.
Management is extremely important. There's an old adage by Mark Twain that the definition of a gold mine is a hole in the ground with a liar on top. It's very hard to find trustworthy management teams that are effective in the gold business. So there's some practical stuff, like can you get the gold out of the ground for less than you can sell it for? So can you make a profit? That's the most important question I ever ask. Like, can you make a profit, and how much profit are you going to make per ounce of gold? That is the most important question. And then I rate the management and their honesty to some extent. Their track record is quite important, but their ability to deliver, because just because you have a beautiful business plan doesn't mean you can actually execute it. And so it's a combination of the quality of the asset, your ability to get it out of the ground at a profit, and the ability of the management team to deliver.
And can you tell all that or some of that just from reading reports, or is that really something you have to do with sort of direct visiting of companies and that?
I won't buy any company where I haven't met management, usually more than once. Okay. It's just too important a factor in a company's ability to perform.
Okay. A question at the front here.
Is investing in a gold ETF a safe investment?
Yes. Well, a gold ETF is a proxy to the bullion price, paying a small fee for their management of that. But generally speaking, ETFs are a very good way to invest in gold bullion.
Asset managers don't like them very much, do they? They're sort of cutting you out of the equation in many cases.
Well, there's two kinds of ETFs, right? There's ETFs that buy gold itself. So it's a lot easier for the average investor who wants direct. He doesn't want to take the risk of investing in gold companies because that's riskier innately. And he wants to invest in gold bullion, he'll invest in an ETF. And if you want to invest in senior gold producers, an ETF is pretty good as well. I mean, asset managers don't love them, but at the end of the day, they're a very reasonable way to get exposure to gold.
But wouldn't that also depend on the solvency of the ETF provider?
If an ETF is traded on a global exchange, a reasonable global exchange, it gets arbed in baskets. So you can create or redeem units, and a prime broker does that for you. So it doesn't matter how if it gets really small, if it's a very small ETF, you might not want to touch it. But frankly, mostly they're quite. If it's an accredited ETF traded on a major global exchange, you're probably safe.
Okay.
Amanda, I've got a question from one of our people who has been looking at this at home, and this is from John Griffiths. He's asking about something which you touched on earlier. This is all this talk there's been about the ability of people to sell oil to China direct and to do that in the RMB instead of in in dollars and the fact that you could then buy gold with it. You've already touched on this. John clearly thinks this has been a bit of a damp squib, but what we were told was this was going to change everything.
Okay, the gold denominated, so the gold denominated yuan oil contract is important, but it's important insofar as it's just one more thing where gold is underlying and supporting the value of another asset class. It's another form of reserve. In order for it to truly make the gold price go up, this is a brand new product. It only started trading earlier this year. You need huge amounts of transactions in gold to happen. And there's very few transactions that have been denominated with this new options contract yet. Like millions, not billions. And until billions are being traded in it, which may or may not happen and we don't know, it's not going to seriously affect the gold price. It's a question of time. But options contracts take time to be important. And what is important is that a major country in the world, one of the most important countries from a trade perspective in the world, is willing to take gold as a form of currency or to pay gold as a form of currency. And that underlies gold's value in a new economy that is frankly moving away from the US dollar and moving away from a paper currency system. They want something more substantial to back it up. And what's also interesting is all of the countries that are selling oil may or may not eventually prefer to get US dollars or gold instead. It's very interesting. Turkey and Russia are two of the countries that have been significantly increasing their gold. China, Russia, and Turkey are the three countries that have most significantly increased their gold reserves, as in increased them by about 10% per year, which is actually quite difficult because they have quite large reserves. And they're continuing to do so. And what that means is that major institutions, major countries, are worried about the global financial system, and they want something more secure in the background.